Welcome to the daily stock review of Roblox. The goal of this channel is to uncover the world's best stocks that have 100x potential by reviewing 1,000 stocks in 12 months. That's roughly 3 days. If that sounds good, subscribe to come along. Who am I? I'm an individual investor on the journey, just 2,500 hours in over the last 7 years. And I'm sharing the lessons along the way. Here's my investing process. It's got 5 steps. Where to look, and I'll tell you how I came across Roblox today, and then the 5-minute check. These are the investors that I've learned from. They've done pretty well for themselves over just a little while, and by following in their footsteps and the breadcrumbs that they've left behind, we should be able to achieve some of that success. If you'd like the free resources, calculators, tools, checklists, and things like that I wish I had when I first started, grab the link in the description. It's all for free. Let's get cracked into it. Now, Roblox, just looking in the last 5 years, the stock has had a fair few ups and downs, with it traveling pretty much sideways for a few years here, and then all of a sudden, in 2025, it's gone off like a rocket, and from then, from a high of around $135 a share, it's then dropped 70% down to where it is today. And just in the last month, and pretty much the end of trading Friday, it's dropped from $48 down to $35. So that's a huge drop. Now, is this a value opportunity? Is it a time to jump in on Roblox and have a look at it? Is this a great business, and should we be looking into it if it's going to meet my plan of finding the world's greatest businesses? All right, so that's where I came across it. I was having a look around in the 52-week lows for some institutional investors and came across Roblox. So I want to have a look at the 2025 annual report. After doing a bit of digging, because this has the proxy statement, which is about 100 pages, and then the 10K annual report, which is the US filing code for it, the 10K. We can then have a look at the business financials. So I want to have a look at the income statement first. It's also known as a statement of operations. And when I'm looking here, I can see that revenues from 2023, 2024, 2025 have grown. And so the business is pretty much, in terms of revenue, has doubled in going from 23 to 25. A little bit less, but pretty much on that path. And if following that trend, it would have only been maybe a few months or midway into 2026's reporting period. Now, let's have a look at the cost of revenue. So all these costs are going up as well. And our developer exchange fees has doubled as well, from 740, so we're talking 740 million up to 1.5 billion. Infrastructure and trust and safety is increased as well. Research and development is, to a lesser extent, still growing. We'd still want that within a business. It's usually what keeps a business competitive. General and administration and sales and marketing. So total costs and expenses, loss from operations. So just looking here, and we're not even down at the net, what would be net income. So loss from operations is $1.2 billion in 2023, $1 billion in 2024, and 1.2 again in 2025. So even with this huge revenue growth, the business isn't making a profit at this stage. And so that's a problem, because at the end, what do we got for a net loss? Consolidated net loss attributable to non-controlling interests and stockholders. So we want this one here, consolidated loss. is pretty much the same. There's a couple of little bits and pieces that go in here, like interest expense and things like that. But it's operating at a loss of $1 billion a year. Now, let's have a look at the balance sheet. Just want to have a sanity check on it. Don't want to spend too much time here. So is the current assets and, total assets has increased from 7 billion to 9.5 billion, and our total liabilities has gone from 7 billion up to 9 billion as well. So that's not really a comfortable kind of ratio. You'd always like to see that your assets is bigger than your liabilities, and you want to have a bit of margin there. So a bit more of a difference than less than $500 million, just as a percentage wise. And what else? It's 5% pretty much. Now, what else are we looking at? What about the current assets? So current assets minus total current liabilities. The current liabilities for this most recent year is actually larger than current assets. What's going on? Deferred revenue. We've got as a main driver, we've got long-term debt and operating lease and deferred revenue. So with the business making a bit of a loss, there's going to be some funky little accounting quirks that are going to have to happen when the business starts making a profit, or depending on what the requirements are for the country it's operating in, it may need to pay some of those debts to the tax organisations before it starts to operate at a profit. Some businesses are allowed to run for a certain number of years and then they still have to pay it back. So that's kind of a problem. The business isn't very healthy on its balance sheet. There's definitely worse businesses. There's definitely better businesses. So let's have a look at the cash flow statement. That'll help us understand where management's funding the $1 billion loss. Is it based on anything in particular or not? So we've got a consolidated net loss. That's from our income statement, or the bottom line of the business. Comes out on the cash flow statement and it gets its adjustments from there. So we've got depreciation, stock-based compensation expense. So these are the expenses that the business hasn't had to spend money on yet, but it is required by accounting requirements to put that money to the side for the future. And so what it does is it takes that off the income statement. So we've got a absolutely huge amount of money here. So compared to our net loss, that pretty much just gets wiped out completely and it would be operating at a profit. So stock-based compensation expense is very high. What else can we see that's interesting in here? Accounts receivable, deferred cost of revenue. Like I said, business isn't making any money at this stage according to its incomes. Deferred revenue is a huge amount. So changes in operating assets, net of effective acquisitions. And then we get net cash provided by operating activities. So the business generated in actual cash from its operations, its main portion of the business, the core business part of it is $500 million, about 800 million, and then $1.8 billion. And so majority of that is sitting in this deferred revenue. So this cash comes with it to this year, but at some stage in the future, that's why it was sitting on the liabilities. It's going to have to pay this back. So they can hold on to the cash for the time being because their net incomes don't show it because of wonderful accounting principles. But the business got to keep that for this stage. Now, what has the business done with that cash for the meantime? Should we have to portion out some of that and keeping it on the side? Then we've got purchases of intangible assets, which is a small amount. And then we've got purchases of investments and maturities of investments. So really they buy some things and they sell some things, and that's really just to maintain their cash position and manage their cash flow. Sales of investments. So another pretty significant amount of money. Net cash, from net cash and cash equivalents used in investing activities has been a drain on that. Proceeds from issuances of common stock, so they're actually still offering shares and pretty much printing additional shares. It's not a substantial amount, but it's still not really a good sign on a business. You want to see them either not touching the shares for long-term shareholders because it causes a small amount of dilution, makes their one piece of the pie that little bit smaller, and reduces the value of each stock. We'd rather see them repurchasing or just doing nothing with them, or reinvesting the profits within the business so it can grow. So at this stage, I can't see anything really. It's interesting to see that property and equipment has bounced around so much. But at this stage, looking at it, do I think this business is going to be within the bracket of 100x business? No. The business is running at a loss on its net incomes. It is producing some cash, but majority of this cash is coming from this deferred revenue. So in future years, it will have to pay that back. There's a huge stock-based compensation that's getting put into it, which is a very high number when we think about how much net cash this business could be making. And to pretty much have it getting, or what will happen in the future, when this business does hit some of those milestones, it's going to need to pay these out to its employees, and that general trend and the amount is very high. So instead of the business reinvesting into the business, it'll be reinvesting into its employees instead, not increasing that value to the shareholders. Think of it like a bucket with holes in. The bigger the holes are for stock-based compensation, the less value or less water that can be held in it, and shareholders don't get any of that. It just leaks out. And that's the whole point of investing. We want to be intelligent and rational shareholders. This business doesn't fit our criteria, so we're going to move on. Now, would it appear to be a value opportunity? I don't think so. This stage, the business would need to change how it's monetizing its product, so it hasn't mastered its customer in that respect. It may have increasing revenues. Lots of businesses can do that and run at a loss. It's a difference between having your product priced appropriately and the customer seeing the value of that product and be willing to pay for it. So there is a gap between price is what you pay and value is what you get. And at the moment, for the business and for its customers, they're pricing the business at a certain rate, but the value that the business offers those customers isn't enough for them to pay enough and have it monetized appropriately. So that's pretty much it. If you like this breakdown and you'd like to see some other ones of reviews, feel free to subscribe, and otherwise check out this next video because YouTube reckons you'll like it. Cheers.